Okay, so welcome everyone. We start with our last lecture. Hopefully you can all hear me. If you cannot hear me, then raise your hand or let me know. Send a message or speak up. In order to speak up, you need to unmute your microphone and then you can talk. Okay, so today we're gonna mainly focus on the take-home assignment that you're going to finish within the next 2 weeks, as opposed to a take-home exam. Okay, I do think that you should be well prepared to do the take-home exam. However, there are also a few new components that I would like you to work on, which we will focus pretty much in today's session. The due date will be December 22nd. Okay, it's a Sunday, so right before Christmas. What else? As I said, there will be I'll be available for personal office hours this Friday. Okay, so I think you have a few couple of days to work yourself into your assignment, and then if you have questions, then it would be really great if you would stop by my office this Friday. In order to make a meeting arrangement, just send me an email, okay, and then we can schedule something accordingly. Okay, so let me start with the slides of today. Yeah, so everything is uploaded already by now, and we'll go through all of this together. Okay, so I'm gonna share my screen. Okay. Okay. Okay, there we go. All right, so first of all, I would like to highlight that I've assigned everyone a different M&A deal. Okay, and you're going to find your specific M&A deal either in this presentation or in the separate file that I've uploaded to Blackboard, and it's called the Student M&A Allocation or Student M&A Deal Allocation file. So you'll find your name, and then you'll find information on the target company, on the acquirer, and the respective announcement date. Please note that I've not validated the announcement date. Okay, so but it should give you an indication in what year at least it happened. Okay, so before you kind of like work on your take-home assignment, then you should kind of like validate the respective date. Okay, so I think so I've mainly focused on kind of like the biggest M&A deals of the past 3 years. I think there are some very interesting deals among it. Some of them are purely US based, as most of the M&A deals are happening in the United States, but there are also deals for the European market and also the Asian market. Okay. So this is how the take-home assignment looks like. So what you should create as the take-home assignment is a so-called merger report. Okay, the merger report should not exceed 20 pages. Okay, with a font size of 12 according to Word. Of course, you can create a PDF and then upload it if it's better. And the report should not have more than 8 pages of an appendix. Okay, where the appendix could include some of your calculations, some extra information you'll find important maybe. And as I said, the due date will be December 22nd. So what are the points that the merger report should include? And I've listed the 10 major points that I would like you to discuss. And I think most of them are familiar with what you've done in your previous homeworks. So the merger report should include, first of all, a description of the history of the target and the acquiring company. You should outline the historical performance of the target company and the acquirer, as well as the current sales and the profit mix. So where's most of the sales generated in terms of the region, in terms of the segment, in terms of the distribution channel. As you all know, you'll find all of this information in the consolidated financial statements of the two companies that you're looking at. Then I would like you to dive into the description of the history of the merger. So what is the purchase price? What was the share price before the pre-merger? Things like that, as well as kind of like the timeline. Okay, so when did, for example, the media report about rumors that the two companies are going to merge? When was the official announcement date? When was the merger finally confirmed? So I would like you to present sort of like a timeline of the things that happened. Then, and probably this is new, we have not covered it, but we're gonna discuss it today. What I'm also interested that you provide a description of the financing structure of the merger. Okay, meaning that how was the purchase price paid? Was it paid in cash? Was it paid by issuing new shares? Was it paid partly by raising debt from a bank? And what I would like you also to do is then accordingly to talk about the economic implications of this financing structure. Okay, we're gonna discuss later today what these economic implications could be. All right. Then I would like you to focus on the motivation of the merger. So what's kind of like what are the arguments that the management of the acquirer or the target are mentioning in terms of what they potentially see as a benefit. And accordingly, I would like you to focus on kind of like the expectations that the management has from the deal. So what I mean by that is that you should be looking on, of course, the proclaimed arguments of the management, but also kind of like how these arguments were assessed by the financial arena. What I mean by that is by, you know, how did maybe media report about this transaction. So it could be reported with a positive sentiment or with a negative one. I think you can find that very quickly and easily if you make a Google search or a search using the Factiva database that we have at ESCP. and it doesn't have to be comprehensive, but you know, just the general sources like Bloomberg or Thomson Reuters or the Wall Street Journal or Financial Times. This could be something that you could discuss in your merger report. Besides, it would be maybe interesting to see how, for example, sales growth varies between the target and the acquirer, and how a combined sales growth for the future maybe would look like, how the regional breakdown of where the sales are generated could change as a consequence of the merger, as well as cash flows. And if mentioned by management, would be interesting to outline what synergies the management sees, and in particular what amount of, for example, savings they see as a consequence of those synergies. So this would be also something that would be great to cover in your merger report. Then point 7 would be the analysis of the share price reactions to the announcement, and this is pretty much what you've already done as a homework. So what I would like you to do here is the share price analysis using the WRDS database, so words around the announcement date, for example, as well as kind of like maybe like a long-term analysis of how the share price of the acquirer in particular has developed after the acquisition. Then I would like you again to look into the consolidated financial statements and look at the purchase price allocation of the acquisition and describe that. And so it would be just, I mean, it's pretty much a descriptive task. However, it could be something interesting to talk about if you feel that, for example, the goodwill is very, very high, and how again management argues why they have paid such a high price premium. And finally, once you've discussed the purchase price allocation and the premium, which is the goodwill, right? I would like you to dive a little bit into the rationale for this premium, okay? And this is what we're going to also talk about today. So the question is really, okay, how can we justify a high premium? So how much do earnings or cash flows need to increase to back up the high premium, okay? So what I'm looking for in this task is a little bit kind of like a backwards calculation to find out what the assumptions of management have been with regard to those proclaimed synergies as said. So what you could be doing here, although I do not give like a particular scheme that you should follow, is to calculate the necessary improvement in terms of, for example, an earnings increase or increase in the long-term growth or increase in the free cash flows. And finally, what I would like you to discuss is the post-acquisition leverage of the acquirer if debt was involved. So if debt was involved, of course, this is going to change the leverage of the acquirer. Even if debt is not involved, once we merge the two companies, you know that also debt is summed up for the two companies. And so the question is, how does post-acquisition leverage look like? How does this compare to firms in the same industry? And most importantly, do you think that the risk of financial distress has increased? Okay, and what I mean by that is by simply looking at, okay, for example, the debt to equity ratio increased significantly, or is the interest coverage, has it gone down? Where interest coverage would be the EBIT divided by the interest that the company will need to pay every year. Okay, so these are kind of like the 10 points. In particular, on point 9 and point 10, we're gonna kind of like I have a few slides prepared for that we can discuss. But in the meantime, do you have any questions on the task? Okay. If not, then let me continue. So, as a broad concept, what we are looking for in this merger report is whether we think that the merger creates any value for the acquiring firm's shareholders. Okay, this is kind of like the ultimate goal that we're looking at, and this is why we are kind of like analyzing, the strategic fit of the acquisition, as well as the rationale for the purchase price. So, question of course is, okay, one can assess an M&A deal from different angles. So we could assess a deal from the point of view of the acquiring manager, or from the point of view of the security analyst, or from the point of view of the target management, or for the point of view of the investment banker. Of course, in our task, we're going to focus on the point of view of the security analyst. So what we are particularly interested is, as I said, whether we think that the proposed acquisition or the ongoing acquisition creates value for the acquiring firm's shareholders. So in order to kind of like start this evaluation, whether the merger creates value or not, there are four broad topics that we look at. The first one is the motivation for the acquisition. The second one is, as I said, the pricing of the offers, then the forms of the payment, and then sometimes what might be very important is the likelihood that the offer will be successful. So we're going to now discuss each of those 4 points in a little bit more detail. So in terms of motivations of the merger, just to give you an outline of what management could discuss, so what you should be looking for or maybe describing in your merger report is where there are, first of all, any economies of scale mentioned. For example, this makes sense if, for example, two car manufacturers merge and then they can kind of like combine their production facilities to increase their economies of scale. Another reason could be the improving of the target management. So what you could do in that regard, how the target company has performed up to the date of the acquisition or the announcement. So whether, the stock was regarded, for example, poorly, or whether they had a below average industry performance, then it might make sense kind of like to say, or the argument is that, okay, now this company is run by bad managers or below average managers. So if we buy the company and then we replace the management, then we can increase the value of this firm. A third argument could be the combination of complementary resources. For example, if the two companies are in an industry with a lot of R&D expenses, it might make sense to kind of like to merge, to again have efficiencies in terms of this research and development process. Other motivations that could be found in the arguments of the management are providing low-cost financing. So meaning if the target company, for example, has a high debt-to-equity ratio or describes in their consolidated financial statements that they have a rather high cost of debt, then of course it might make sense if the two companies merge that now they can renegotiate their financing conditions, and then an improvement can arise out of that. Creating value through restructuring is something that is very, very frequently mentioned. What is very often meant by that is kind of like reducing the headcount of the two companies by, again, combining the resources. Penetrating new markets, something that is kind of like argued in the recent past. China is mentioned a lot in this regard. However, be careful with respect to what is kind of like mentioned in terms of new markets. If you think that kind of like market entry to China is overemphasized, then we as a security analyst should be skeptical about that. Another factor is that, okay, if two smaller companies merge together and sort of become a market leader within the industry, that one can increase the product market rents. What I mean by that is one could, for example, just rise prices because competition has been reduced, and therefore we have a higher margin on our products. And then finally, motivation that was very often mentioned in the previous century. It was diversification, so meaning that, okay, if we combine our operations with something or with another company that does something completely different, then, you know, kind of like if one industry goes down, there's a likelihood that the other industry develops differently, and so therefore we could provide benefits to our shareholders through diversification. However, this should be regarded critically, as the shareholders could just buy shares of different firms and then diversify by themselves. Okay. So the motivations for the acquisitions and the anticipated benefits disclosed by acquirers or targets should be carefully assessed in order to get information about those potential synergies and about whether the merger is going to create value. In that regard, it's as I already said, it's important to analyze from which industries the target company and the acquirer come from. So whether this is a horizontal merger across industries, or whether it's a vertical or unrelated merger, or it's a vertical merger within the same industry. Or it could be kind of like across the supply chain. So it could be that we're acquiring a supplier, and therefore we see kind of like benefits across the supply chain. Merger report should then also include kind of like the discussion of the key operational strengths of the target and the acquirers, see how well those fit, and also maybe a brief discussion on whether this is a friendly acquisition. So meaning supported by the target management, or whether this is a hostile acquisition that is, so to speak, it's the target management fights against being acquired. Pre-merger performance of the two firms, it's already outlined, could be important to look at. So how did the company develop in terms of stock price, in terms of earnings? For example, 3 years, up to 3 years or 5 years before the announcement date. And then kind of like a new aspect as well, what is the tax position of both firms? So does the acquirer or the target company has any tax loss carry forwards? So what I mean by that is, if you made a significant loss in 1 year, what you're allowed to do with the tax authorities, you can take those tax losses and forward them into the future periods to reduce your future taxable income. Okay, but however, sometimes those tax losses are so high that the companies are not able to use those tax loss carry forwards fully, and so from this angle, sometimes it makes sense to merge with a more profitable company to be able to use those tax loss carry forwards. This is something that should be mentioned by management, but besides or beyond that, you could look out for the mentioning of tax loss carry forwards in the consolidated financial statements of the acquirer or the target. Okay, the acquisition pricing and analyzing the premium. Of course, ideally, how we could analyze the premium is to look at comparable transactions. However, this is often very difficult, right? Because it's really, really kind of like hard to find the same transaction in the same industry of a similar size, and then be able to compare the premium. However, this is why we do our stock price analysis. Meaning that what you should do is kind of like to look at the price reaction of the target company as well as of the acquiring company when the announcement of the merger occurred, or for example when the deal was closed, and elaborate a little bit on that. To give you a little bit information about premiums in general. So in general, in terms of friendly M&A deals, there is very often a premium paid. The premium ranges normally between 25% and 40%. However, if the transaction is a hostile takeover, then we see a tendency that the premiums are about 30% higher than the normal premiums, so they are around 50% then. So 50%, what I mean by that, above the fair value of the net assets, okay? So, of course, we need to understand, or we understand by now, that if a very, very high premium is paid, then it's much harder for this transaction to create value for the shareholders of the acquiring company, right? Because we need to kind of like we need to improve performance so that the shareholders get back this price premium that was paid for the deal. And so, like in the worst case, this could put the whole creation of value story at stake. Okay, so how can we assess the acquisition, or whether the premium is reasonable or not? The first thing you could do is to look at the earnings multiples of the target company, the acquiring company, and maybe on the average multiples within the industry that the acquiring firm or the target firm is located at. So you could look at, or you should look at, price earnings multiples and or price book multiples, both before the merger and after the merger, to get just a feeling for how the market regarded the companies before the acquisition and then after the acquisition. Of course, there are some limitations of the price earnings valuation, but the benefit is that it's a very, very simple tool to analyze kind of like the reasonableness of the pricing story. So a little bit more detail on how the method of comparables works here. So after we, for example, if the target is traded, then we have already a multiple ratio for that. So we can we have a starting point, and then we can look for comparable firms, so firms that are similar to the target company, and look at their for example, price to earnings ratio, and then look into whether kind of like the industry average is different from the particular multiple of the target company. Give you an example for how this calculation look like. So if we think about, okay, maybe so if we assume Dell is the target company, so we can observe sales for Dell, we can observe earnings for Dell, we can observe book value for Dell, and we can observe also sales, earnings, and book value for two of their main competitors. We can also observe the market value of Hewlett-Packard and the other competitor, Lenovo. And as we have those 4 figures, we can calculate the price, for example, the price to sales ratio for Hewlett-Packard and for Lenovo, the price to earnings ratio for the 2 companies, and the price to book ratios for the 2 companies, okay? And from those multiples, we can sort of assess what the market value of Dell should be. Okay, and a possible approach would be if we would like to combine, for example, all of these 3 multiples together. And what we could do, we can take the average sales multiple of Hewlett-Packard and Lenovo, which is 0.67, and apply it to Dell's number of sales. Okay, we get a valuation, for example, here at $33 billion. Same with earnings. Average earnings of Hewlett-Packard and Lenovo is 17, applied to Dell's number of earnings yields valuation of 45 billion roughly, and the book value average 2.8 times Dell's book value of equity yields valuation of 21 billion. As you all can always see, depending on what multiple we use, whether it's a sales multiple, an earnings multiple, or a book value multiple, the valuation can vary significantly. Okay, so it might make sense just to use an average valuation. So this is something where we could value the target company and then compare it to the price that was paid. Okay, this is something that you could build into your merger report. Do you have any questions on this multiple approach? Okay. Yeah, there are some implementation problems of this multiple method, and these are the following. Mainly, sometimes it's just hard to find comparable companies where you could apply, or where you could derive those comparable multiples from. Sometimes maybe we might have different accounting methods used for the comparable companies and the target companies. As you've already seen, there are different prices arising from different multiples, so sometimes it makes sense to kind of like combine the different multiples together, kind of like average out those errors. It's very difficult if, for example, a company reports negative earnings, then we have kind of like the problem that we have a negative denominator, and then this whole calculation is a little bit distorted. So we need to think about what should be done with respect to that, and to leave out those companies that report a loss. And if an IPO is kind of like acquired, or a private company is acquired, then these are firms that are not traded. So then kind of like this, we're kind of like we are missing the reference point. Okay, so just some additional information. You don't necessarily need it, but if you kind of like, if you cross so if you walk across those terms, just that you know what they describe. So we distinguish between the trailing, for example, PE ratio, a rolling PE ratio, and the forward PE ratio. The trailing PE ratio is the price per share of the stock divided by the most recent annual earnings per share. The rolling PE is the price per share of the stock divided by the sum of earnings per shares for the most recent 4 quarters. That's a rolling, okay? So we're not waiting until the full year is done, but we're rolling, from quarter to quarter, always averaging out 4 quarters. And then there's a forward PE ratio, where we divide the price per share by the forecast of the next year's earnings per share. Okay, so frequently, like very much for bigger companies, analysts issue forecasts of next year's earnings per share, and so this is what should be used here when calculating the forward PE ratio. You should also pay attention to that PE ratios usually should be dividend adjusted, meaning that if dividends were paid out in a particular year, then we should add the dividend per share that were paid out to the price per share before dividing it by the earnings per share. Kind of like the rationale behind that is kind of like in our consolidation of the equity method. When dividends are paid out, then of course you reduce cash in the target company, and you receive it as a shareholder. So in other points, the price per share of the company should go down, and so we need to add it back to make dividend paying and non-dividend paying companies comparable to each other. Okay, just to get a general sense of what typical values for common multiples are. If we just focus on, for example, the forward PE ratio, what you can see here is the companies were assigned to different percentiles. So the top 5% of the firms, they report, or they have a forward PE ratio of 49.2, so a very, very high PE ratio. The median companies, kind of like the average company, has a forward PE ratio of 13, and the lower 5%, they have forward PE ratios of 5.6, right? So if you would try to find companies here, so for example, Tesla would be something around a PE ratio of 50 or maybe 200. I think Amazon has a PE ratio, forward PE ratio of like 70. Then companies like Siemens, they have a PE ratio of around 15, so they are kind of like the average company. And then currently the automotive industry, so the car makers, they currently have forward PE ratios of 5. Okay, so multiples are one way you could kind of like analyze the acquisition price against the benchmark. An alternative approach would be to use either a discounted cash flow model or a discounted abnormal earnings model or residual earnings model. In general, what one should do, one should first assess the target on a standalone basis as a starting point, and then think about any improvements that could arise either in earnings or in free cash flows from the merger and acquisition. And then so we kind of like make a projection of kind of like earnings on a standalone basis, and then we think about potential synergies, for example, cost savings. Maybe there are cost savings of 0.5 or of 500 million each year. So we kind of like add to those forward or forecasted earnings 500 million for each year to kind of like put in the potential effect of those synergies. And then, of course, we discount this future forecasted earnings stream or the future forecasted cash flow stream to the present value. Talking about the discount rate a little bit, I think you should all be familiar with the concept. So the discount rate or the cost of capital is computed as the risk-free rate plus the risk premium. Okay, the risk-free rate is usually taken or is assumed to be government bond, a 10-year government bond. For example, if you're looking at the US transaction, you should look at the current interest rate paid on a 10-year government bond, and then we add to that the so-called beta factor of the target company times the market risk premium. So the beta factor, hope you all know that. I mean, it's measuring how much on average the price of the stocks moves when the whole market moves. Okay, so if the beta factor is 1, then what it means is that if the market moves by 1%, then the stock of the company also moves by 1%. Okay, if the beta factor is 2, then it means that if the market moves by 1%, then the stock moves by 2%. Okay, one could calculate that. You could calculate that by yourself. The way to do is would be to download prices for an index, so for the market, download prices for the particular firm you're looking at, and then for example, using Excel, you simply regress the monthly return of the target company on the monthly return of the market. You don't necessarily need to do this for the equity report, as I do assume that you can find the beta factor for your target company on the web. Okay, you can use sources like Yahoo Finance, or you can look at the Words database. It should be easy to find. But if you have problems, or if you would like to calculate it by yourself, then please approach me, and I will let you know how to do this. For sure, I will upload a document that describes how you could do this. Okay, and then what you need to do with the beta factor, you multiply it by the market risk premium. Regarding the market risk premium, it's kind of like hard to assess what the market risk premium is. For simplicity, I would just recommend you to use a market risk premium of 5%. So for example, if we try to value Hewlett Packard in 2010, and during that time the long-term US government bond rate was 3.5%, now it's around 2%, and Hewlett Packard has a beta factor of 1.5, and the assumption market risk premium is 5%, then we can calculate, so to speak, the discount rate or the required rate of return by taking the 3.5% plus the beta factor 1.5 times the market risk premium 5%, and we get a discount rate of 11%. Okay, do you have any questions on this calculation so far? No? Okay. Yeah, so let's continue. Yeah, so after you've calculated the discount rate, and you would like to, for example, apply the discounted cash flow model, you should approach that task as follows. First of all, discounted cash flow, free cash flow model, what it assumes is that, what it looks at is first of all, the forecasting of the cash flows from operations. So what are the future inflows from the target company, and what are the cash investments that the target company needs. So the cash flows from operations minus the cash flows from investment gives us our free cash flows for example, the future periods. And so what we need to do then, like in a second step, is to discount those free cash flows to the present value. So the term that you see here, this is rho. This is the gross required rate of return, or gross cost of capital. So meaning 1 plus, for example, the 11% that we just have calculated. Okay, up to the power of 2 for 2 years, up to the power of 3 for 3 years. And so on. So this is how we implement the discounted cash flow model. Of course, in the end, we need to think about what the terminal value is, and there are some approaches to that. So how can we capitalize the terminal free cash flow? Well, first of all, we need to project the free cash flow at the end of the forecasting horizon, and then we divide it not by the gross cost of capital, but by the gross cost of capital minus 1. Okay, so we're pretty much we're dividing it by the cost of capital itself, and this is how we get the terminal value. If we assume that the terminal free cash flow comes up with a future growth of, let's say, general GDP, for example, like 2% or 3%, then we need to deduct from the cost of capital the growth rate. Okay, so here G would be 1 plus the growth rate, so that 1 is cancelled out. In general, it's the cost of capital minus the growth rate. So this would be the approach to a discounted cash flow model. So an example could be the following. So let's assume that we are again, or this time that we are calculating a value for Coca-Cola. So we need to think about, if we're now in year 1999, we need to think about how cash flows from operations will be in 2000, and in 2001, 2002, 2003, 2004, what cash investments will be to get the kind of like the free cash flows. As I will show you later, you don't have to come up with that numbers by yourself, but this is something that we can download from the Words database. So in the Words database, we find forecasts of analysts, so we can use those forecasts into such a simple valuation scheme, discount those free cash flows with our discount rate, so that we have the present value of the cash flows, then calculate terminal value. As I said, we're assuming, for example, like in this case 5% growth rate, discount that terminal value to the present value, and sum it up with the present value of the free cash flows. We get an enterprise value here for Coca-Cola of $105 billion minus the book value of net debt. We get the value of equity. Okay, divided by the shares outstanding, we get the value per share. This is how we could again compare the purchase price paid with an intrinsic valuation. Okay, any questions on that discounted cash flow valuation?
Sorry, so in the report, do we have to insert a table, a graph like this one, right? That we can find that, like, we don't have to do all the calculation by ourselves, as you said, but we can find, and do we have to insert like this in the report?
Yeah, so I leave it a little bit to you, right? So in the merger report, you should do some form of analyzing the reasonableness of the acquisition price. One approach could be calculating those multiples, and if you think that the multiples kind of like make sense and it all looks good or so, then it might be okay to just focus on that. An alternative approach would be to calculate the intrinsic value according, for example, the discounted cash flow model. What you will find in a database, and I'm going to show you where you find it. Okay, what you're going to find is a projection of the analysts in terms of future cash flows per share. So what you will get is kind of like the projection for the next year, for the next 2 years, or for the second year, for the third year, I think up to the fourth year or fifth year or so. But as you'll see, kind of like there are more analysts who just project the first year and less analysts that project the second or third year. But what you find in the database is kind of like these line here. Okay, what you then still need to do, however, is to do the calculations. Okay, but I do think that the calculations are not very hard, right? It's just first of all to come up with a discount rate. Okay. And then secondly, to discount those free cash flows to the present value, and then also in terms of the terminal value to assume maybe a growth rate to come up with in the end a value per share. Does this answer your question? So in other words, you don't find the calculation ready for you, but you do find the most important thing, which is the assessment or the forecast of the future numbers, and then you still need to do kind of like the simple DCF calculation.
Thank you.
Okay. Just one thing I would like to highlight: sometimes this discounted cash flow model is difficult to implement, and one example could be General Electric in the years 2000 until 2004. Although this applies to every growth company. So if we look at their cash flows from operations and their cash investments during that time frame, you see that General Electric or GE has invested more into the future business than they have generated from operations. So the free cash flows for all of these 4 years have been negative. Okay, and this is usually also true for high growth companies. They're investing more that they generate from their existing assets. So, and the problem is, okay, if all these free cash flows are negative, then you cannot do evaluation with it because you're discounting negative numbers, so the whole value will be negative. Okay, so in this case, it might be just too hard or might not make sense to use the discounted cash flow model, but to use as an alternative an earnings-based model. As you see, during the same time frame, earnings for General Electric have been positive and then also slightly growing. As you can see, for example, their earnings per share have been $1.29, $1.38, $1.42, and so on. So looks like a very steady increase in the earnings per share. Okay, and the reason for that is, of course, that under accounting, cash investments are often just capitalized, so they are put on the balance sheet and then depreciated against or depreciated and matched against sales, and then you can still show a profit while you have negative free cash flows. So in this particular case, it might make sense to use not the discount cash flow model, but to use the residual income model. And so I'm going to outline to you how this model looks like. So again, this is relevant for those of you who are dealing with a target company that has negative free cash flows. So here the value of common equity is estimated by taking the book value of the equity at the acquisition date or announcement date, and then we add to that a forecast of so-called residual earnings. So residual earnings for year 1 after the acquisition, year 2, year 3, and so on. And then those residual earnings are discounted to the present value. So like using the same procedure as we just have seen for the discounted cash flow model. So what are residual earnings? So just that you know that residual earnings are simply the earnings, so comprehensive earnings, minus the required rate of return on equity, okay, times the beginning of the period book value. Okay, whereas required return for equity, for simplicity here, you can use simply just the cost of capital. So what you've kind of like would use in your discounted cash flow valuation, you multiply it by the beginning of the period book value, okay, and you subtract it from the comprehensive earnings. Okay, as you move from year to year, you should know that the beginning of the period book value will change. Of course, the beginning of period book value will change from year to year. First of all, it will increase by the earnings that the company has generated, and it will decrease by the dividends that the company has paid out. So this is how you can calculate kind of like the book value from year to year. An alternative way to present residual earnings, we just look at this term here on the right, is to calculate the return on common equity that the companies generate. So this is just earnings divided by the book value of equity, of common equity, okay, minus the required rate of return, so the cost of capital, okay, this is the gross required rate of return minus 1, Okay, so we have kind of like a return on common equity spread. Okay, so if the company generates 15% in return on equity and the cost of capital are 11, then the spread is 4%. Okay, times the book value would also yield the retained earnings. So this is an alternative way, which might be maybe easier to think about. So kind of like the drivers of residual earnings valuation are twofold. It's not just the return on equity, so that it's higher than the cost of capital, but it's also how much the company puts into the book value. If they pay out a lot in the dividends and do not reinvest it back into the company, they are not using this positive spread that they have fully, so the valuation has to be lower. To give you again an example how valuation scheme could look like. So here it's for Nike. We are in 2010. So in 2010, Nike reported earnings per share of $3.93, dividends per share of $1.06, and book value per share of $20.50. Okay, 15 cents, not percent. And then from a database, we would get for the years 2011, 12, 13, 14, and 15, we would get forecasts of analysts in terms of earnings per share. So for example, as you can see here, analyst forecasts, the median consensus forecast, which is just kind of like the middle point of all the forecasts that we find in the database. 2011 is $4.29. For 2012 is $4.78. And in terms of kind of like growth rate over the next 5 years, they are assuming 11%. So from that we can estimate earnings per share for the next kind of like 5 years. Dividends per share. Usually we need to think about an assumption, like for example, if it's dividends per share could either be constant or it could be related to the earnings that are generated. So here they are related to the earnings that they are generated. So here what you could apply is just kind of like the same percentage of dividends per share in relation to the earnings per share to come up with a projection of the dividends per share for the future. We get the book value per share for the future periods, as I said, by taking the beginning of the year book value per share plus the earnings per share, okay, minus the dividend per share, and this is how we get the ending of the year book value per share. Okay, so this is how we can kind of like move through these calculations here. Having the earnings per share and the book value per share, we can calculate the return on common equity. It's just earnings per share divided by book value per share, right? Earnings divided by book value of equity. So we kind of like receive for the future that the return on equity for Nike for the next 5 years is going to go down slightly. Assuming cost of capital of 9%, we can calculate residual earnings. Okay, would be just 21.3% minus 9% times the beginning book value per share. So it would be here the 20.15, and we get the residual earnings for the particular year. Then using a discount rate, we get the present value of retained earnings. And then we have the total present value up to 2015. For 2015, again, we need to think about the terminal value. So regarding the terminal value, usually what we use is, of course, the last projection in terms of residual earnings. It's the $3.395. Here, calculations assume that Nike will grow in the following year by 4%. So multiply that by 4%. And divided by the cost of capital minus the long-term growth rate. Here it's, I would say, rather high, 4%. So kind of like the assumption is that Nike will grow forever by 4%. And this yields a terminal value of 70.62 for the year 2015, right? And again, we need to discount that back to the present value, which is then 45.89. And we get the value per share by adding the present value of this kind of like continual value or terminal value plus the total present value of our kind of like a short-term forecast, we get a value per share for Nike of $77.24. Okay, so this could be something that you, again, if you don't think that a multiple based valuation makes sense for you and a DCF calculation doesn't make sense to you, what you could integrate in your merger report. Yeah, so here are the two methods next to each other, and there's something I like to highlight here. So as you can see here, again, there's kind of like a projection in terms of, here it's in terms of revenues and depreciation, but it could be just earnings per share. And then what this, for example, this residual earnings approach up here also assumes is a strategy income from, arising from the synergies of an M&A deal. Okay, so you can see here that in addition to that earnings projection, we are adding a so-called strategy income. So kind of like they are building up synergies over the next 4 or 5 years, which then ultimately result in synergies of, let's say, 900 million in year 5 and beyond. And this is what we could build into the valuation schemes if we would have information on that. Sometimes management talks about how much potential they see in terms of, for example, cost savings. This is something what you could separately build into such a valuation model in order to rationalize the valuation. You could do the same for the discounted cash flow approach. I mean, no matter what method you use, usually kind of like the valuation should, or theoretically the valuation should result in the same number. Okay, but it's at least just theory. Okay, so do you have questions on the residual income approach? Otherwise, I would go into the words database and show you where you find those projections. Okay, so let me move on to the words database. Okay. So I log in. So you all created the account, hopefully. So let's log in. Okay. For the return calculation around the announcement date, we used Compostat, capital IQ. Regarding any analyst forecast, you'll find information on the so-called IBES database. So this is the link here. So if we click on IBES, it's a database, I think, also by Thomson Reuters. Yeah, it's maintained by Thomson Reuters. What we find here is a gathering of all the information of the large brokerage houses and the individual analysts. So you find information of, by how many analysts the respective companies are followed, and what those forecasts of the analysts are. So we need to distinguish between an individual analyst and, so to speak, the analysts in aggregate. Of course, it's kind of like, it makes more sense for our task to just look at the projections of the analysts in aggregate, so to look at kind of like the whole sum. So you'll find that under summary history. So if you click on that, summary history, and then summary statistics, this is a database where all the analyst forecasts are combined together. Okay, and then the output is just the median forecast. Okay, median forecast means just the forecast in the middle. So not the very good forecast for the company, not the very bad forecast in the company, but just the forecast in the middle. Okay, so if we have 9 analysts following a company, then this database just looks at the forecast of analyst number 5. You would sort it, for example, on the value of, for example, an earnings per share forecast. Okay, so how do we download data from here? So again, I would like to use Linde as an example. So the first one is we can choose between IBES statistical period, so when they gather the information together, versus the forecast period. Then I would just stick with IBES statistical period. And the second one, what technically that we need to do is to look at the data range. So I would maybe download 2 or 3 years around your merger, just to make sure that you don't miss anything. So the merger I've looked at with Linde is the merger with Pixar, which occurred in 2017. So what I would like to do is then I would download data from beginning of 2016 to maybe the end of 2018, December 18. The official ticker of Linde is LEN. Okay. It's in the international file, and now we need to specify the measures that we're interested in. So for example, for residual earnings calculation or discounted cash flow calculation, we need the earnings per share, that's already in here. We need the book value per share forecast. We need maybe the cash flow per share forecast, and the dividend per share forecast. Okay, so these are kind of like the 4 measures that we need. We don't know the others, so there are some more, return on equity forecast and so on and so forth, but I think it's enough to download just those 4 forecasts. And then we kind of like we see the time horizon of the forecast. So fiscal year 1 would just download the forecast up to 1 year. Okay, fiscal year 2 would download the data of up to 2 years. So we can use fiscal year 1, 2, 3, 4, and 5. So all of this 5 years. And what we also be interested is the long-term growth rate. So what are the analysts assuming for the long-term growth rate of the company? In addition to that, there are additional information like the official ticker, maybe company name, the number of estimates, so how many analysts did forecasts for the company, the median estimate, this is pretty important, standard deviation, currency code, might be a different currency maybe, and maybe periodicity, so how much in the future are they forecasting. Okay, I'm going to use a CSV file, non-zipped. I'm going to hit submit query. So the query runs, so this might take a little while. But this is how you could download all of the data for your particular companies and then build your own small Excel-based valuation model following the scheme that I've just presented to you. Do you have any questions on the download or on anything so far while this download is processed?
Can you hear me?
Yes, you can hear.
Ask you a thing about the download of this kind of data. For what concern the report, do we have to use them specifically for which part of the report?
So just for the part of analyzing the share price premium, right? So after you've discussed the history, then the prior performance to the deal, then the strategic arguments, the strategic fit and the savings and the purchase price allocation, then we're down to the price premium. So kind of like to the goodwill, how much is the goodwill resulting from the company? And then you could call it kind of like the analysis of the price premium, and here you could build in either a multiple-based valuation model, DCF-based valuation model, or residual earnings valuation model. You don't have to do all of the three, but just choose whatever you feel more comfortable, and then discuss a little bit on what you think, whether it's reasonable to pay such a high price premium or not. Okay, often it's totally fine if you say it doesn't make any sense that they have paid so much as a price premium. There's no way, if you look at the projections of the analysts, there's no way that they are able to generate this value for the shareholders and even beyond that in the future. So it's totally fine to do that. You just need something to back up your arguments, and this is why you should use one of those three approaches.
So we used a WRDS database just for the premium part.
Yeah, I think you just need it for the premium part. Because this is this IBIS, so it's International Brokers Estimate System or something. That's just kind of like the abbreviation for that. What you can find there is just the forecasts of earnings per shares, book value per shares, cash flow per shares, and dividends per share. So it's a database used for valuation purposes. Okay, you don't find merger reports in detail there or something like that.
Okay. Sorry, just another question. In point 2 of the point that you provided us, you say the outline of the historical performance as well as the current sales and profit mix by region, segment, distribution channel. Here you mean of the merger of the single companies.
So kind of like before and then of potential how it will look like together. So what I've also uploaded to Blackboard, I didn't talk about that yet, but I've included kind of like two templates for merger reports. One is rather short. I think I've already uploaded this last week, right? This is like very short one, just 9 pages on kind of like mainly on strategy, not so much, a little bit on kind of like segments. So this is something that could like inspire your merger report. And yesterday I've also uploaded in like a little bit larger, like a textbook merger report with a lot of more detail. Okay, so this is something but it's also similar what we've done, right? So what's the kind of like the share price reaction to the announcement date, so that you can see here an analysis of the target company. In this case it was Puma, yeah, their sales mix by region, by distribution channel, their historical performance, also the acquiring company. In this case it was PPR, now called Keuring, right, the French luxury article company. So a little bit on their history. You don't have to do it in the detail. It's just an inspiration for you what you could do. Okay, so it also includes sales by region, sales by segment, and what you're referring to is okay, how could the company look together? Okay, so what you could do is, for example, this year. So looking at PPR on a standalone basis in terms of their sales segments and their geographical split, and then if you would combine it with Puma, which is just much more, I think, much more represented in the US, or so how would the sales mix change if you would combine those two firms, right? So how would the gross margin be different? So if Puma has a much higher kind of like gross margin, and we combine two firms, how would the combined gross margin look like? How would the sales by region would change if we combine these two companies? So this is something what I mean by looking at potential consequences of a sales mix, so that you kind of like, if the management argues, okay, we are able to enter new markets, that you kind of like can pre-assess it in the numbers of the financial statements already, whether this actually is true or not, or whether this is only marginal, right? So here it seems like if PPR and Puma merge, then, for example, the geographical split would not change a lot. Okay, there's just a small shift, a little bit more sales in the Americas, so North and South America region, a little bit less on the European and Asian kind of like market, and but not too many changes, right? So there it wouldn't make sense to argue that you know, we're gonna enter new markets if they merge together. So in terms of geography at least, right? Could be the different distribution channels could be used, of course. So this is kind of like what I mean by you know, like combining the operations of the two companies, hypothetically, at least. So answer your question?
Okay, thanks a lot.
Right, so just going through this merger report a little bit. So they, so here's a lot on the strategy, on the segments, distribution channels, less so on the valuation. There is a little bit on the valuation in terms of, I think, multiples. So just historical statements. I think yeah, okay, there's a projection calculation as well. It's a little bit different than what I've shown to you. I think it's more detailed. You don't need it that detailed, but it's also something that you can look at. Okay, some better information, tax rate. I think there was yeah, some multiples also Puma's multiples compared to the competitors, and so you'll find an example for that here as well. Okay, but you don't have to, just to make it clear, you don't have to like copy this 25-page report or copy this equity report and Krispy Kreme much shorter. It should just be an inspiration for what you could discuss in your merger report, and what you should discuss are the 10 points that I have outlined to you on Blackboard. Yeah. Okay, so let's go back to, I think our download should be ready. So let's check. I think I've already open it yet. Oh no, I have to click on it there. So here's our download. Okay, so let's open that one. Okay, so here it is. First of all, recommendation for me is just to take a filter, and then, for example, for my company, for Linde, they're not 3 companies listed, but so there's the main company listed, and then 2 subsidiaries listed somewhere, at least with their bonds or so. So we're gonna eliminate those first. So we just stick with Linde. The first important variable is the stat pers, okay, variable, which is the IBIS statistical period variable, which just gives you information on when the consensus forecasts have been aggregated. Okay, so you can see they've aggregated one mid of April, one mid of May, one mid of June, one mid of July. So it seems like every mid of the month they are, you know, this IBIS database combines all the analysts around that date. Okay. Measure here in this case is earnings per share, right? So we can decide upon where we'd like to look at earnings per share, dividend per share, cash flow per share, book value per share. Just focus on the earnings per share first. This is the long-term growth. Maybe we delete the long-term growth as well. We would like just to focus on the forecast. On the forecast made in June. So FPI1 stands for, is it the forecast for for the end of the year? FPI2 would be the forecast for in 2 years, 3 years, 4 years, and 5 years. So this is the forecast until the kind of like the end of the year, 2016. I think I missed to download a variable. Let me switch to that. So I think the variable that I've not downloaded here, unfortunately, is this one here, the FPE date is the financial reporting date. So here you can actually see what date is forecasted, right? So maybe we go back and do this again and add this important variable FP forecast period end. Okay, this one. Forecast period end is what I forgot to download. So let me click on this again. Yeah, but you can see it also in the indicator. So if I look into kind of like 2 years in advance, I would see the MEDAS. It's the median forecast in terms of earnings per share. So in May 2016, they forecasted I think it's in dollars, it's in euros, €7.54 to be the the median analyst forecast of that particular month for in 1.5 years. So it's 7, and then 757 the next month, 755. So you see it changes, but not too much. Usually changes, but here it seems to be something happened, and then the median forecast jumped by €1, right? So it could be something to do with maybe like a projection as a consequence of the potential merger rumor or announcement, right? So in from February to March 2017, the projections have changed significantly. Query is still running. Okay, so yeah, so we could, as I said, we could use earnings per share, or we could use the cash flow per share. So you can see here to calculate your valuation or the book value per share, and so you would need to just copy those numbers and put those numbers into such a valuation scheme to come up with a valuation then. Okay, yeah, one more thing I would like to discuss, and it's the financing. So as I already said, the merger report should include a discussion how the acquirer has paid for the acquisition. So did they issue stocks or warrants? Did they use cash, or did they raise new debt? And there are some trade-offs between those alternatives. If you think about it a little bit, so if you issue stocks, to the target company's shareholders, then the target company's shareholders become the shareholders of your company. So in this case, if you would have overpaid to them in terms of issuing your shares to them, then they would, they are still participating in kind of like any price downturn as a consequence of that. So in this regard, if you're issuing shares, then so you take those target shareholders into your boat. It's not it's not that, or it's at least less critical whether you've kind of like overpaid to them because you've overpaid to them in your own shares, and then if this was too high and the price go down, some of this price premium will evaporate. Conversely, if you would pay cash to them, any price premium is left with them. They walk off and they keep the price premium. So what the company does in terms of acquisition financing not only has capital structure effects, we'll talk about it like in a second, but could be interpreted by the market differently, right? So if you use your own cash, this is rather received by the market to be more positive, okay, than if you use issuing new shares as to finance the acquisition, because here you either take the target company shareholders into your boat, or you think that your own stock is overvalued, So it's signaling like different things to the market, and this could be something bad or negatively affect the consequences of your deal announcement. So this is something what you might discuss. Besides that, yeah, as I said, the debt to equity ratio and, for example, interest coverage ratio could change as a consequence of the deal. So it might be interesting to discuss, okay, by how much does it change, and whether the risk of financial distress has increased. Okay, so if debt to equity kind of like doubles as a consequence of the deal, then it's something worth about talking. If it's all equity financed, then or debt to equity ratio is reduced, then something may be positive to talk about. There are two things that you don't have to mention in your equity report, but just that you've heard about it. Sometimes there are tax effects from how you pay. So if you pay cash, usually the target shareholders are taxed upon their gains. But if you pay in shares, then the target shareholders are usually not taxed, because they're just switching shares, and so they do not need to pay taxes on that. Only when they kind of like cash out, they need to pay taxes. So there are some tax effects on the target shareholders. However, if you issue shares, then usually this comes with transaction costs. So you need an investment bank to again to work on the issuance of the new shares. So this comes with additional costs. If it's just cash that you're using, you're just transferring the money, and there's no significant additional costs associated with that. So as I said, kind of like in your report, questions that you might address in terms of acquisition financing is, again, what is leverage for the newly created firms? How does this compare to the leverage for comparable firms in the industry? What are the projected future cash flows for the merged company? Are these sufficient to meet the firm's debt commitments? So just looking at the kind of like the interest paid, and then if there's a lot of debt raised and the interest that need to be paid goes up, how does this compare to the operating cash flows that the company is generating? So in general, how much cushion does the company have for its future debt obligations? Okay, sometimes acquisitions are subject to approval, or often they're subject to approval, on the one hand by the target company's shareholders, then by the target company's management, or other potential acquirers could step in. So there are a lot of uncertainties, so a lot of unknowns when you start a bidding process. So it could be that in your particular M&A deal, that the target management didn't want a takeover, and so they engage into different strategies to prevent the acquisition. So if this is happening, this is something interesting to talk about in your merger report. Also, very often, as companies are becoming bigger and bigger, there could be antitrust and securities issues, meaning that big acquisitions, they need the approval from the Security and Exchange Commission in the United States, from the European Commission for the European Union, and also by the Chinese government sometimes, or Japanese government, if it's kind of like the company is located in Japan or China. So very often there are antitrust discussions. So, does this merger create a company that will harm competitiveness in this particular industry? So if this is the case, this might lead to delay in the merger, and maybe lose of kind of like efficiencies. If you find, when you kind of like do research on the particular deal, if you find that this is kind of like a big issue, then this is again something that would be interesting to see in your merger report. Okay. So this is pretty much it in terms of the outline of the take-home assignment. So yeah, again, the 10 points that you should discuss. Due date again is in like 14 days from now. So kind of like my recommendation is kind of like to try to work during the next kind of like 3 days, so that if you have questions, that you can visit my office hours this Friday already. However, if you need if you need to meet with me next week, I'm also available next week on campus. Or if you cannot come to campus, then we can also organize virtual office hours and discuss your particular case. So let me know. I hope this take-home assignment, I think it sounds like a challenge, but I hope that it also brings a lot of fun. I think it's something very valuable, very interesting, because you're doing an analysis in depth, and I hope that you can take a lot out of it. I also hope that you're well prepared for that, as a lot of these points have been already, you've already worked on a lot of these points in your take-home assignments, and the kind of like only new thing or major new thing is this valuation. And so if you have questions in terms of how to work on the valuation again, then as I said, the doors are always open. Let me know.